I want to start with the U.S. So according to your most recent research, the idea of 150 basis points in cuts by the Fed this year, it's realistic. The only question is it good cuts or bad cuts? Please explain.
Absolutely. In fact, the markets have pretty aggressively priced in a lot of rate cuts, more than 150 points, but they haven't really priced in the distinction between good and bad cuts. A good cut would be where interest rates come down because the inflation rate comes down, expectations of inflation are stable, and we have a nice reduction in the real interest rate, inflation-adjusted interest rates. But if we had the kind of situation that you just talked about where geopolitical risks start to fly, the supply chains get to be threatened, energy prices are destabilized, and the economy starts to tank because of stagflation, rising inflation, and high unemployment rates, then the Fed's going to have to cut very aggressively to try to keep the economy buoyant. And that is a bad rate cut because that's the sort of rate cut where nobody wins.
I do want to ask you, the Fed's mandates about inflation and employment, in your mind, I don't know, you may not have an exact number, but how big of a factor are some of these geopolitical tensions? Again, the Israel-Hamas war, the Ukraine war, and what we're seeing in the Red Sea?
When economists really talk to each other, especially in the policymaking tables, geopolitical risks are things that you leave at the side, at the very end. You say, oh, yeah, we got to remember the following things. But right now, the Houthi attacks are showing that the U.S. is not able to really keep this shipping through the Red Sea safe. And because of that, supply chains get threatened. We're not going to be able to get stable energy prices if this thing continues, and the costs of importing goods start to rise. That becomes a frontline issue. It's no longer the thing you relegate to the back.
So, Bill, I want to broaden this out just a bit. On Monday, the PBOC, they left a medium-term policy rate unchanged. That kind of defied market expectations. Then yesterday, we heard from the ECB saying possibly no cuts at all in 2024. How did the other central banks, how do they digest that, and how do they factor into some of this volatility that we could see in 2024?
That's a great question, because the central bank in China, the PBOC, has recognized that pushing on a string just won't get your economy reviving the way you have to. You really have to get some deep structural reforms in the property market. ECB is saying, we don't have 2% inflation rate, so don't tell us that we're going to be cutting, because we're not going to cut until we see 2% on the horizon, even though Germany's economy is weakening like crazy. So the central banks around the world are keeping interest rates high, and if the U.S. starts to cut aggressively, that will depreciate the dollar and really start to destabilize prices on the import side.
So, Bill, I want to broaden this out also to some of the elections that we saw. We saw the Taiwanese election over the weekend. We had another guest earlier that said about 40% of the world's population, about 40% of the world's GDP, those nations are having elections this year. How does that factor into all this?
I'm so glad you mentioned that, because the Taiwanese election, in some ways, has eased off the tensions with China, because even though the DPP party has been calling for independence, the fact that they lost the parliamentary majority means you've got a split government. And when you have a split government, it's good news to everybody, because that means inaction. So the rhetoric may be there for independence, but I don't think the real action is going to be there to threaten the point where China is going to have to do something. And all the other elections are raising these political risks as well. Sometimes, by the way, they're really good results, because in Latin America, you start to see capitalism reviving slightly. And so in that sense, I think the markets are seeing a slightly more friendly environment in certain key spots around emerging markets.
So, Bill, I want to bounce off some breaking news off of you. This just crossing the wires just right now. China's economy grew 5.2% in 2023. However, that's the lowest growth rate in just about 30 years. What do you make of that news coming out of Davos from Chinese Premier?
I think that means that they have really pumped the economy as much as they can with public spending, because if you actually dig into the numbers, you find that private sector spending is starting to crash like crazy, and they're making up for it with a lot of public infrastructure spending. The Chinese economy is not healthy.